Welcome back. We will continue in the same series of talking about security in the web based system, in your e-based business system, and today we are going to discuss about one important concept which is about digital payment systems. So, in this lecture we are going to learn about the features of a payment system, assessment criteria for electronic payment system, then digital counterpart of the real world payment system and description of the payment methods. To start with, let us see what a payment system is about. A payment system is a mechanism that facilitates transfer of value between a payer and a beneficiary, by which the payer discharges the payment obligations to the beneficiary. The payment system enables two-way flow of payment in exchange of goods and services in the economy. Okay, let us try to understand, elaborate little bit on this definition, what a payment system is. This payment system is a mechanism that facilitates transfer of value between the payer and the beneficiary, by which the payer discharges the payment obligations to the beneficiary. Look, when in a transaction, you carry out in a transaction, you buy a book, you pay cash. Suppose you pay cash. Now, most of the transactions are becoming electronic, but assume that you pay cash. Now, when you pay cash, cash is what? Some pieces of paper. So, when you pay that pieces of paper, why the other party assumes that it is actually value for that particular book? You could have exchanged something else, because if can your shopkeeper take some paper from you instead of the money? No, money has some other characteristics, because of which the shopkeeper takes money from you in exchange of the books. Think of earlier days. In earlier days, people used to exchange in a barter system, people used to exchange things for things. If somebody is selling rice, somebody is selling some vegetable, then they can exchange it, because they understood that value of that vegetable is same as the value of the rice. Now, how come a piece of paper becomes that valuable and it enabled the flow of payment? Because the instrument that you are using, your money is one instrument, is certified by somebody. In India, it is Governor of the Reserve Bank of India who certifies it. So, let us try to understand what is the components of any payment system. First of all, the instrument. Here in this particular example, your instrument was the cash, a note, 100 rupee note, 200 some 500 rupees, 2000 rupees note, etc. Now, there has to be certain rules and regulations and procedures, and what are the other instruments? By the way, what are the other instruments? Other instruments are your checks, demand drafts and so on. There can be many other instruments, and nowadays of course, these electronic instruments are there. Now, through which the payment can be made. So, there has to be certain rules and regulations and procedures that guide this payment procedure. Then there should be some institutions which facilitate the payment mechanism, like that of your banks. There has to be some legal system which established the facilitates rather the transfer of fund among various participants. Participants are the banks, the entities who are connected with the banks and so on. So, possibly in our country your RBI provides such kind of legal system. Now, when you go for making electronic payment, you are going to make the electronic equivalent of the regular payment entities, many items, many important criteria need to be considered. First, the technological aspects like authenticity, non-repudiation, integrity, confidentiality, etc. need to be maintained. To cite an example, let us try to understand that let us say what is, after all, when you do electronic transaction, what exactly you send? After all, it is some data only you send. So, when you send this data, suppose you send that file which contains the data about the payment to the other entity who is receiving it. That other entity may say that he has not received it, because your internet is after all a insecure medium. The other entity can say that he has not received it. What are you going to do? So, you have to deal with this non-repudiation thing. Similarly, authenticity, whether you are sending it to the right entity or not. Integrity, whether the amount that you are sending 10,000 rupees, it should not become 50,000, should not become 5,000. So, similarly, if you are sending some money, confidentiality should also be maintained. So, all these security categories need to be taken care of. Then there is some economic aspect of it. The cost of the transaction should not be very high, it should be within the user's reach. Then there should be value for mobility. By value for mobility, we mean when it goes from the one hand to the other, if let us say we are thinking of some cash equivalent, if it is going from one person to the other, the second person should be able to use it. It should be mobile. Then the financial risks associated with this. Now, of course, we are quite safely, we are doing all the transactions all the time. So, probably we are the electronic payment systems are quite stable now. So, we do not have much financial risk, but time to time we find there are incidents happening which does some some intruders actually coming in and creating havoc in the system. So, this financial risk should be handled. Social aspects, it has many social aspects associated with it, like anonymity. By anonymity we mean in the corresponding physical world, when we do the transaction with cash, do we attach our identity with the cash? No. Probably it is not true for other instruments, but at least for cash it is there. So, there should be, if at all we would like to have some kind of anonymous transaction, that aspect must be maintained. It should be user friendly and mobility about I was talking about. Then regulatory aspect, just like in the physical world, you should having certain regulatory authority to take care of the transactions. If there is any problem happen during electronic transactions, there should be somebody to resolve it. Now, let us try to see what are the real world equivalents in the electronic world. There are certain cash equivalents like DigiCash, Millicent, etc. There are certain check equivalents which like your CyberCash. There are some credit you can over the web you can do credit card transactions. Then there will be through some trusted third party, there can be electronic fund transfer with your SWIFT network. So, let us now go through various e-payment methods and try to see how they work. So, first one is your use of payment cards, cards. So, The term payment card describes all types of plastic cards used to make purchases. This includes credit card that has certain spend limit based on users credit history. You can have debit card which directly helps removing the money from the bank cardholder's bank account. Then you can have charge cards which carries no spending limit, the amount of charge is due at the end of the billing period. There are many advantages and disadvantages associated with it. Of course, first advantage is worldwide acceptance of those cards, then they already have a built-in security mechanism in the real world which helps. Disadvantages: payment card service companies charge merchants per transaction fee and monthly processing fee, which the merchant may not like unless otherwise there is some regulation from government side. Then let us talk about how the through this, when we do transaction through these cards, how the payments are accepted and processed. So, some steps are followed while you use the card payment. The merchant authenticates the payment card. Merchant is somebody with whom you are doing the transaction. Merchant checks with the payment card issuer to ensure that the credit of funds, credit or the fund you are within the within the limit, then puts a hold on the card line or the funds needed to cover the charge, then the settlement occurs. Now, let us look at what are the settlement processes. There are certain closed loop system where the card issuer pays to the merchant that accepts the card directly and does not use an intermediary. This happens like in case of American Express etc., where they are not attached to any bank. There are some open loop system which involves 3 or more parties. For example, your Visa and MasterCard they are attached to the banks. During this process, the merchant's accounts, the person who is supposed to receive the money, they must have some account, merchant account. Now, to process the payment card for internet transactions on online, merchant must set up a merchant account. New merchant account, the merchant account if he has to have, then he has to provide his business plan, details about existing bank accounts and business and personal credit histories. Let us see, as I told you, during card transactions, first the authentication takes place, then the settlement takes place. So, during when you swipe your card, credit card in your device which in turn communicates it, or first we will be talking about when you swipe your card, because that is the first way of electronically communicating your details. So, the customer, when you will be swiping it in the agency's payment device, the card details will be going to card processing center. From there, depending on the nature of the card, it will be going to the respective company. As I was telling you, there are some systems in which the card company themselves directly paying to the agency, like your American Express etc. But in other end, but there are companies like Visa and MasterCard, where the credit information will go to the Visa, Visa will now connect to the issuing bank, and that authorization, it will send back the authorization response. And during this settlement process, after it is authorized and it is known that it is the sufficient fund is available, then agency's payment device makes the payment settlement request, then which in turn is going to all these credit card companies. As you can see, this American Express and Discover, they will be directly sending their money to the agency's designated account, whereas this MasterCard and Visa, the companies like MasterCard and Visa, they will be taking help of the issuing bank and send the money through the card processing center to the some interim account, which later on gets settled and goes to the agency's bank account. So, this is your credit card settlement process. Now, during this transaction, when information flow, should we be using this TLS protocol? Of course, using TLS protocol over the internet when the data is sent, it is secure. But is it truly a payment instrument? Let us try to understand it. TLS supports mutual authentication between client and server. Now, in case of payment transaction, you are going through some kind of card processing center. The moment you give your credit card information, it is now known to the card processing center. So, the card processing center you trust, that is why you give this information, but at the card processing center your credit card information is now known. So, therefore, but ideally what would have happened? Ideally, this credit card information should not even be known to anybody other than the like the companies like Visa, etc., credit card companies, but it is not. It is now known to that somebody else, where which ends your where your TLS transaction ends. So, which you may not want. So, there is no guarantee that the payment information is secure and is not misused by the merchant's server. So, if you are sending your details to the merchant server by giving your credit card details, there is no guarantee that merchant will not be misusing it. There is merchant is involved, there are other parties involved. So, they should not be misusing it. So, there are many solutions to it. The protocol which was been worked upon by this Visa, MasterCard, IBM, many companies actually contributed to creating a protocol which is called Secure Electronic Transaction Protocol, SET. It becomes so secure that the time taken to do the processing become very high, and because of this expensive nature of the protocol, of course, though initially it was proposed to be adopted, it is no more in practical use. So, we are not going to discuss about the SET protocol, but right now people are using trusted third party services like payment gateways, etc., to settle the bills. There are many peer-to-peer methods, which is an online technology that allows the customers to transfer fund from their bank account or credit card to another individual's account via internet or mobile phone. So, there are two types of payment methods under this, through trusted third party like that of PayPal, or through web or mobile interfaces provided by the bank. This PayPal, which is a third party digital payment system, here the sender sets up an account and requests to send the payment. The sender places the payment into the receiver's account by credit card or some mechanism. Receiver is notified of the payment via email, then receiver can transfer the fund to the bank account or request a check. The next physical equivalent is your electronic check. They are similar to corresponding paper based equivalent. Customer need a wallet software to store the information on the browser about the checking account. The encrypted customer's payment information with bank's public key and the other information for the merchant are encrypted with the customer's private key. The merchant sends the payment information to the appropriate bank and gets the fund transferred to its account. Example, CyberCash. Then corresponding digital cash, corresponding digital equivalent of cash is called digital cash. So, this digital cash are computer files containing huge random numbers digitally stamped by the bank. They are encrypted with bank's private key followed by the customer's public key. So, that the customer, because it is encrypted finally by the customer's public key, using customer's private key, only customer who has got the money can decrypt it and they can use it. Now, because it is encrypted with the bank's private key, and if somebody knows the bank's public key, then it is verified that the bank has actually given this money to the customer. Now, it is maintained by the customer's wallet software. It can be classified as identifiable money. It can be online or offline. So, if it is identifiable, then separate protocol. If it is anonymous, then that separate protocol has to be used. In case it is online, the user need to be connecting to the bank while the transaction takes place, and if it is offline, even without the bank's involvement in between, the transaction can take place. However, such money, when they are specifically anonymous and offline, the problem of double spending comes. Now, what is double spending? It is after all a file, and the customer customer himself, and it is encrypted by lastly by customer's public key. So, once the customer decrypts it, it is anyway authenticated by the bank by encrypting it with the bank's private key. So, customer can have multiple copies of the file and use it a number of times. So, proper mechanisms are to be implemented to avoid double spending. Now, corresponding equivalents of digital cash are smart cards like your Mondex, Visa card, etc. As I was telling you, the money can be identifiable or anonymous. In case of identifiable electronic money, it is a serial number provided by the bank for each of the computer file. The CyberCash operates like this. In case it is anonymous money, a serial number is created by the customer using certain cryptographic operation called blinding. It is blinded, and on this blinded file, now the bank signs it. So, bank now verifies that even if the customer's identity is not known, it is actually identifying, it is recognizing that that computer file is actually cash. Then let us see the difference between online and offline money. As I was telling you, this online money is validated online with the active participation of the bank. Example is CyberCash, and offline money is the one which is not validated online with the bank. With peer to peer transactions between two users, the money can be the cash can move. Then the third category is then the next category is your electronic wallet. So, these electronic wallets hold the credit card number, electronic cash, etc. of the along with the owner's identification and contact information. They give consumers the benefit of entering their information just once. And as you know, these electronic wallets have made our lives very easy for shopping. These electronic wallets can be either server side wallets or it can be client side wallet. In case it is a server side wallet, it stores the customer's information on a remote server belonging to a particular merchant or wallet publisher. In case it is a client side wallet, it stores the information on the consumer's own computer. Then you have smart cards. These cards have the computer chips on their face. They are very common in Europe and other countries. They use for healthcare, transportation, transportation ID, retail, pay phones, loyalty programs, banking machines, etc. These smart card readers interface with card and request user PIN for access. Bank machines can load cards with cash and then merchant can download cash from the card. They provide this anonymity to the purchaser as well. This Game Plus, MasterCard are leading suppliers of such smart cards. Besides that, you have B2B payment mechanisms which can happen on SWIFT network, through which electronic fund transfer can take place, electronic bill payment can take place, and there are B2B payment gateways as well. With this we finish this lecture. Thank you very much.